Christian, thank you for being here at the Dario Mambo Show. This is the kind of podcast interview where we talk about business. We're going to talk about real estate, that's the industry we're in. But for the audience, like, who are you and what you do?
Yeah, so my name is Christian Ruiz, and I work for Gold Financial right now. I'm a loan officer, number one, and then I'm also a branch manager as well. Which I don't know which one comes first before the other because they're both equally important. But for right now, I'm doing that. I'm also helping people with, investing, such as I've gotten into like private money lending, and I've gotten a little bit into commercial lending as well as kind of like a side hustle. And, also because I feel like, you always want to keep learning too.
So you're a lender.
Yeah.
And so how'd you get into lending? Like, how long have you been doing this and something you've always wanted to do?
So, I went to college at Incarnate Word here in San Antonio. I got my degree in banking and finance, graduated in 2012.
Wow. Nice.
I wanted to originally go and be like the Wolf of Wall Street in New York and go and be yelling on the phone, trying to buy stocks or whatever. But, I think that family had some businesses out in Eagle Pass. That's where I'm from. And so, I decided I'd go help them because they didn't have anybody with that type of skill.
Yeah.
My family, they have businesses, but, they don't have anybody who knows financing or accounting very well, right?
That's what you studied.
That's what I had studied.
So your family pulled you back.
Yeah, pretty much. And so I said I'd help. I went back to Eagle Pass. We had a couple oil field related companies such as vacuum services, concrete company. So I was helping kind of run that for a while. But, even being the accountant, I'd still wake up at like 3 a.m. to pour concrete to make sure that things are done correctly. And it was a very rough life. And I kind of figured that, that wasn't really the life for me.
Yeah.
After doing it for probably about like 5 years or so. And then at that point, I moved to San Antonio and I got a job doing property tax loans. So, it was related to finance. I was just looking for a job related to finance, managing something. And that's, my expectations of what I could do and what I was doing versus what I was offered was vastly different. I was reset all the way back to just, being a regular employee at some company. And so I was okay with that. But the job itself was very grueling because nobody wants to be sold, a high interest rate loan or told that they're going to be foreclosed or anything like that. So
you're the bad guy.
Yeah. I come home and, I was never really content, like the job itself kind of left you in a depressed state all the time.
And how long did you do that for?
I did it for about a year. When I was there, they told me, that if I went and got my license to do mortgages, that I'd get, some kind of raise or, I'd make more money.
And so that's how you got your toes in.
Yeah. So they said, okay, come get your license. We'll pay for it, whatever. So I took it, I passed it, and I kind of sit there and I was waiting for them to, open up their mortgage division. When I found out one day, the owner said, after, complaining for months that, they were so far away from it, years that, don't get your hopes up too high.
Yeah. So they kind of gave you a little sunshine, but then took the sun away.
Well, I guess he needed some motivation for me to pass it, but maybe I guess he just didn't think that anyone would. I don't know. Because there was other salespeople too, and I was the only one that did, end up passing it out of the other like 4 people.
For your license.
For the for the license and for the salespeople that were working at that company at the time. And so I had talked to my direct supervisor at the time because he's the one that was saying like, let's get into mortgages. He was saying that he was a loan officer for 20 years back in New Jersey or something, New York, something like that. It was from the north. And so I told him like, hey, boss says we're not doing this, man. And then he went in there. Next thing I know, behind closed doors, I hear shouting. He walks out. He quits that day. And I'm like, whoa. Oh, no.
So in your opinion, what is a loan officer's license requirement, right? And also, what does a loan officer do?
So a loan officer, for the most part, I would say that there's several hats, right? There's the sales part, which is not really being salesy, but it's more so just kind of being, available, charismatic, respond fast, so you have to be prompt, you have to be responsive. But also there's like the academic side, right? Which is like, someone brings you a scenario and you have to know lending law like a lawyer would, basically. Someone brings you a scenario and you have to figure out how to navigate that.
So lending law is, you need that information. And if you're not good with people or like the sales part, then you just won't last.
Well, yeah, you really need both. Like you could convince somebody to come and use you, but if you're not actually good, If you don't know what you're doing,
Right.
it's not going to work out very good for you, right? And vice
Right.
versa. Like if you really know what you're doing, but you don't really know how to talk to people,
Right.
well, then no one's
Yeah.
going to come through the door.
So when you get your license, no one tells you that you have to be good with people, right? You just study to get the license, and then boom.
Absolutely. I mean, the license is, even what you study, for the most part, is information that, it's good to know, but it's not something that you're practically going to be using most of the time.
It's very similar to a real estate license. I remember when I got my license and then I started practicing, I had no idea how to do a contract and how to talk to clients. Over time you get that experience. But yeah, you study, you get your license, and now you can work, right? In your experience, Christian, what are the type of loans that people use here in San Antonio more often?
I mean, here I see a lot of VA. We're a VA city. So there's a lot of veterans that come and go here. They get stationed here for a little while. They buy a house. Maybe it's a couple years, maybe it's 4.
Yeah.
They leave. They got to sell it. They need to
Yeah.
buy another house somewhere else. So there's definitely a lot of VA in San Antonio. I do have a lot of also first-time home buyers. I do a lot of down payment assistance programs. I tend to think that the median income in San Antonio is very, very low compared to the rest of the country. And so I think that for a lot of people here, those programs are really a lifeline
Right.
to allowing them into home ownership.
What's your opinion on the medium household income compared to the medium sales price of homes?
I mean,
Does it correlate, or is it,
no, it absolutely does not correlate right now. It's
Yeah.
it's a complete paradox. Back in 2020, roughly, or maybe even 2019, I used to use a certain program from the city of San Antonio. It was called the HIP 120 program.
The 120.
Homeowners Incentive
Yeah,
Program.
yeah,
And I used to call it the builder killer.
Yeah.
So that means that, like, if somebody was shopping me with a builder,
Yeah.
and the builder's like, hey, let me pay all your closing costs, I'd be like, oh, I can do that too. And
Yeah.
you can pick any house that you want.
There you go.
And people were like, really? How can you do that? And I would offer that program because back then the house prices weren't so high, the interest rates weren't so high, and the average person could afford a home, and they could use these programs to qualify.
What the average salary?
Correct, because these programs are income locked, right? If you
Right.
make too much money, you don't qualify for the program. So right now, I believe that the average median income statistically is around like 68,000 for the city of San Antonio. And these programs, they say, hey, you cannot make more than the average person,
Yeah.
but also you can't max out what you normally would. So
Yeah.
like if you could normally afford a 200K house, if you want our free money, you have to buy a house for like 180 or 170. But not only
Wow.
that, it has to be new. It cannot be really old, or we'll make you fix it. And it has to be within the city limits, where everything's the most expensive.
Yeah.
So it's like right now, I really believe that down payment assistance is truly broken for the average
Yeah.
American.
Yeah.
And there's only a couple programs that do work for DPA, but just barely.
Yeah.
And I have been talking with several people from the city
Yeah.
to try to make some reform with this, because
Yeah.
I feel like the American dream is little by little kind of disappearing.
Well, let's get into that. But before we do, I had a question for you.
Sure.
You mentioned you do FHA loans, VA loans. You work with a lot of first-time home buyers. In your opinion, what's the difference between FHA loan and a VA loan, and what are the pros and cons of each?
Okay, so I mean, typically if you do qualify for VA, you always want to go with the VA loan, right? The
So
VA
if you
loan,
can qualify, use it.
absolutely, because the VA gets a lot of special treatment in a lot of different categories. For example, the VA doesn't even have a limit as to how much of a home that you can buy. If it's your first time buying a home, there's no limit for VA.
You can buy $1 million home.
You
with
can
a
buy
VA.
$1 million, you can buy $10 million, whatever. I mean, as long as you qualify for
Yeah.
it, right? As long as you
Yeah.
make enough money and your credit's good. Not only that, but VA also, the rates are typically a little bit better too. And there's no down payment, and if you do have any amount of VA disability, now, you can avoid even the fees to get the VA loan. And if you have 100% disability, then you're not even paying taxes.
Property taxes.
Right. So
Is there any closing costs for VAs?
So
buyers?
there is closing costs. One of the ones that I just mentioned was, if you're using a VA loan, there is what's called the VA funding fee,
Yeah.
which the VA charges to keep operating. Typically, that could be in the thousands of dollars. It's usually 2 to 3%, depending if it's your first or second
And
time.
that's a cost to the buyer.
It is finance, so it's not like they have to bring it out of pocket right at that
It can
spot.
be financed into the loan.
But you pay for it anyways, right?
Wow.
There's also, regular stuff like the appraisal, the survey, the title.
Home inspection.
Yeah, all that normal
title
stuff.
fees.
So
a VA buyer probably just has to pay like the appraisal, the lender fees.
well, I mean, in this case right now in this market, where there's not a lot of buyers, typically the veterans are not really paying for much. Typically it's just probably the earnest money because you have to put something down to contract.
Yeah.
And then usually it's just the appraisal.
And
Sellers are
inspection.
paying for and home inspection
Yeah.
for sure, yeah. But sellers are paying for everything else.
Man,
right
so now I can see why getting a VA, if you can qualify for a VA, use it because you get a lot of benefits.
Absolutely.
How does it compare to FHA loan?
So FHA, is a program that I believe was designed by the government to allow, people into home ownership. It is incredibly lenient. It could, VA allows you to buy with the low credit score, but so does FHA. FHA does have a minimum credit score requirement of a 580. That's what the law says. Now, it's funny that the law says that because, we have to advertise it legally the way that we're told to.
Right.
But, nobody really knows this, but when you get a client's application in, we put it into a little computer system, and it's not even a human being that tells us whether that client's approved or denied. We push a button on the computer, and it sends it to a website that belongs to the government, which is typically, Fannie Mae or Freddie Mac.
Yeah.
And a little algorithm occurs in the back, and then the computer says, yes, you can lend to this person, or no, you can't, right?
So the credit score is not really like the only determining factor.
Absolutely not. You can say, hey, 580 is the minimum, but every time I put a 580 into the system and I say, give me a result, usually it does not approve it.
Yeah.
Typically, you have to have what's called compensating factors. And so that means like, someone having money in the bank after the transaction's closed, or maybe perhaps they haven't had any lates in their credit report for a year, or we verify with their landlord that they made all their payments on time. That's a verification of rent. So these are all what are called compensating factors.
Wow.
Yeah.
So we kind of reviewed what a VA loan is, what a FHA loan. What's the down payment for an FHA?
So FHA has 3.5% down, and it does have a loan limit. They change every single year. I believe right now it's like 468,000 or something like that.
It depends the county you're shopping in.
It does depend on the county, absolutely. For Bexar County, I believe it's around 460 something. Anything beyond that is technically not FHA, lendable on. I guess FHA insurable. But I should clarify and say that the loan amount, not the sales price, right? So if you pick a 500K house and you put 100,000 down, you can still get an FHA loan. I don't know why you would want to.
Yeah.
Because that would probably be more of a conventional route to go.
Right.
Because you get rid of what's called mortgage insurance, right?
Let's talk a little bit about mortgage insurance on an FHA loan. Like, how does that work and why is it there?
So basically, mortgage insurance was the idea created behind the 2008 housing bubble or crash. And when that occurred, basically, you had that Barack Obama too big to fail campaign.
Yeah.
If you remember, they were printing money and giving it to the banks.
Yeah.
Okay. So basically, everybody had their money invest, in a bank, whether it's in a checking account or a savings account or whatever, right? So imagine, you're living your life, you have your money in the bank, and then one day the bank knocks on your door and says, hey, I lost all your money. And so essentially, like, these banks, they lent money out to a lot of individuals and they didn't get it paid back, and so they basically went bankrupt, right?
Yeah.
So in an effort not to cause like some kind of massive recession where innocent bystanders just lost their whole life savings, the government made that too big to fail campaign, right? So mortgage insurance was designed so that if people do default on their houses, this insurance basically pays back the lender whatever's owed, because essentially, the lender's going to go and try to get the money out of, whoever they can, right?
Yeah.
And foreclosures and all that causes recessions. So with that being said, it's basically everyone gets punished.
Yeah.
Everyone has to pay this insurance in the event that your neighbor defaults, and for FHA, it's for the life of the loan. It's there forever. Yeah. VA doesn't have that, and conventional only has it up until you pay 28%, or if you put 20% down in the beginning, it doesn't have it at all.
So with the conventional loan, you have mortgage insurance is kind of an option or a factor only for so long.
So yeah, I mean, essentially, the way the banks kind of like, I'd say like hedge their risk. Is if you put a very small down payment, and most of the money's lent by us, we're going to want to make sure that if you decide not to pay,
Yeah.
You know, we have like 95% of the bill, you know, and you only have 5%
Yeah.
at stake. You know, we want to make sure that that insurance is still in place
Yeah.
in the event that the guy says, hey, you know what, I just put down, you know, 10 grand. I don't care if it gets lost. You know, whereas the bank has maybe 200K on the line.
Right.
You know what I mean?
Yeah.
So for conventional, the insurance stays there all the way until they pay 20% of that loan off. Or if, you know, in this market, you know, the houses have appraised a lot lately. You know, if the house appraises and now you know you have 20% of equity in the home,
Yeah.
you can always refinance and get it removed.
So if you have a conventional loan, and say you bought 4 or 5 years ago, and you're not really sure if you're at 20%, how can you find out? You call your lender up, you ask for an appraiser, you look at the BCAD, you look, Zillow tells you. Like,
Well, I mean, I would say the first step would be call someone probably like yourself.
yeah.
And say, you know, hey, can you do a, you know, comparable market analysis as a realtor for me? Because realtors have access to all of this stuff, right? And it'll probably be a lot cheaper than paying for a full-blown appraisal if you just wanted to like get a rough estimate, right?
Right. To get an idea of.
Yeah.
Yeah.
At the end of the day, though, the bank is going to order an appraisal. So don't order one yourself because then you'll pay for two.
Got it. Yeah.
Yeah.
Got it. And then so the bank does the appraisal, let's say appraises, and you now have 30% equity because the appreciation of the house has gone up. And then what happens? The insurance goes away. The mortgage.
So I mean, basically, you know, you would have to do a refinance, right? Or essentially, you could contact whoever you currently have the mortgage with and provide that information if you didn't want to refinance, right?
Got it.
But in most cases, if they've already applied with me, it's probably because they need something.
Yeah.
Whether it's a refinance or whether they're trying to get cash out.
Yeah.
Especially in this environment where the rates are so high.
Yeah.
You know, you're not going to see a whole lot of that right now unless they need money.
Nice.
You know?
Nice. Now you're saying they're calling you because they need something, so they probably want to refinance. What are some of the creative ways a homeowner can use let's say the equity they have in their house as a way to either buy more properties or maybe take that money for home renovations, or they want to go?
Oh, that's a great question.
Yeah.
Yeah. So there's a couple ways. One way is, you know, doing a cash out refinance where you completely refinance your loan and pull
What's
the
a
equity
cash out refinance?
So essentially, you know, you have your house and, you know, let's say you owe something or maybe you don't, you know, it's regardless of the point, this is how it works. You know, you put your house up as the collateral, right? So you basically say, hey, you know, if I don't pay, you know, what's at risk here is my home. And we lend against that property, and, you know, we lend up to 80% of its value, you know, that they can pocket, you know, and use that for whatever that they want.
Yeah.
So that's one way. It's, you know, it's a cash out refinance. I typically don't recommend this way because the rates are so high right now. And if you have a house that has a really low rate, you know, to go from like a 3 to a 7,
So if you do
it's going to change your payment a lot.
So if you do cash out refinance, you're basically starting the loan over again.
Correct.
With the current rate that's going on.
Now, you could always choose to do it at any amount of time. Like, you could do it for 20 years. You can do it for 15 years. You know, but most people don't elect for that because now you're getting the whole debt again.
Yeah.
You know, you want that payment kind of low.
So what's a good way to pull your equity out without having to change your interest rate?
So you also have, you know, the home equity lines of credit, also known as a HELOC. You know, that's where you basically get a second mortgage, and it works kind of like a credit card in a certain way, right? So
It's revolving credit?
it's revolving in the sense that you can spend it, pay it back, and use it again, just like a credit card, right?
And you have to go through a bank, or you can use a mortgage broker for this?
So you can definitely use a mortgage broker, and you can use a bank as well, but it does have to be like the actual lender does have to be a bank that has like, you know, deposits and, you know, because a mortgage company doesn't have the ability to do HELOCs, right? Now, there is a couple other ways that I've started dabbling into as well. You know, I've had a lot of people call me about, you know, wanting to build something and they have properties that are paid off. So long as the property that's paid off is not your homestead, you know, we can always do hard money loans on that as well, up to 65% of that property's value.
So you're using the property as collateral?
Basically, except, you know, in this case, it's not scrutinous, you know, compared to, a regular loan where they like literally almost take your like blood type.
Right.
You know, on a hard money loan, you know, they don't even pull credit. They don't even do an appraisal. You know, we're just going to do a CMA. You know, we're going to look at the equity and we're going to lend you 65% of it.
Why is it so much more lenient?
Well, number one, it's private money. It's not like going through a bank. It's not going through my license. It's not going through federal. And anything that's residential where someone's going to live in,
Yeah.
you know, an individual's rights are very heavily protected.
Right.
But when it's an investment property, you know, there's basically, it's no man's land. It's like whatever you and I
Yeah.
agree on, right?
Yeah.
So this is why these investors, these private money lenders want
Yeah.
to lend on properties that are not homesteads. So that, you know, if we agree on something and you default, I can take that without having to go through this very lengthy
So
process.
the worst case scenario, the person defaults, you still have an asset that you can acquire.
Correct. And we could sell it to get, you know, our money back. You know, versus like when people default on a home that they live in, it takes a very long time. They can still
Yeah.
foreclose and take
Yeah.
that away. But, you know, you could live in that house for a year,
Yeah.
maybe two,
Yeah.
before they actually like take it from you.
Right. Right.
You know, depends on, you know, how much time they have,
Yeah.
the effort that they put behind it, all of that, right?
How would you describe the difference between conventional financing and hard money?
So I would describe it as like, you know, conventional financing is you're going to a bank, you know, expect to get your credit pulled, expect us to look at, you know,
Your
all
debt
of
to
your
income.
financial docs, you know, your tax returns, you know, your pay stubs, we're looking at your bank account.
Mm-hmm.
You know, we're going to make sure for a fact that you have the ability to pay this thing back because the government puts that burden on us.
Mm-hmm.
And if we don't do the due diligence, people like me can actually go to prison for that kind of stuff.
Yeah. So you're held liable standards, and then the borrower has to go through this application process that you need to get approved for.
Absolutely.
And that's
you know,
conventional. That's like financing.
and we're the licensed people. It's
Yeah.
our fiduciary duty to make sure that we're doing the right thing
Right.
for the person that's coming to purchase from us, right? Whereas, you know, private money lending, there's literally no safety net, right? You know, you come in, whatever agreement you strike with, that's what it is. And, you know, hard money can have really high interest rates.
Right.
You know, they can go up to, I was talking to a guy yesterday, he was doing 14%, which I thought was really high.
Yeah.
You know, I offered him somewhere around a 12%, and he was very happy with that. But I have seen some people, you know, even get lower than that. But as you know, the environment changes really quickly, and even from last month to this
Right.
month, the rates went up. So,
Yeah. What are some of the terms of a hard money loan or private money?
so the main things that we look at is we look at, you know, we look at the scope of work. You know, what needs to be done on the property that you're trying to purchase? Are you trying to?
So in other words, why do you need the money?
Yeah, why do you need the money? And we want to know itemized lists like, you know, what are you going to do with this money? Because if I see you building a $200,000 house and you put here your countertops are going to be 10 grand, I'm going to question you like, hey, are you importing these marble countertops from
Yeah.
Italy? Like,
Yeah.
why is this normal home needing
Yeah.
10 grand for countertops? Maybe you should get countertops from Lowe's instead.
Right.
You know, because it doesn't fit this home. So we just also make sure that like the builder is building something that's going to be marketable. You know, we don't want to invest into something that looks very wonky or something that's
Right.
not commonly seen in San Antonio.
Got it.
You know, we also look at what's called the ARV, which is the after repair value of something. So we look at the current value, and then we say, okay, what do you want to do to it? And then we say, okay, well, what do you think it's going to be worth at the end?
Yeah.
So we have, you know, the current value, we have the scope of work, and then we have the after repair value.
Right.
So if all of these things make sense, you know, here's the price, this is what I'm gonna spend on it, and it's gonna be worth so much more later, then we bet on that winning horse, basically, right? So you can actually get into flipping properties and selling stuff like this without actually even using your own money or needing to pull money out of a home with a HELOC or anything
Yeah.
like that.
What are some of the costs associated with the borrower borrowing private money? So like now you explain,
Sure.
you know, the terms, but on the cost side.
So for sure, you know, hard money is going to be a lot more expensive. But I would also argue that anything you do business to business is always going to be more expensive. If you go to try to get a commercial loan from, you know, brick and mortar bank like,
Yeah.
you know, Wells Fargo or
Right.
Chase or whatever, you know, they're also going to have very high rates compared to like a mortgage, right? You know, if it's commercial.
Yeah.
Their mortgage rates will be comparable, but their commercial rates will be higher, right? So when we talk about like, you know, hard money having high rates, I would say that they're still very comparable to a full-blown commercial loan that you would get at a brick and mortar bank.
Yeah.
In terms of like the rate.
So
Now,
hard money is more similar to commercial lending than
in terms of the rate.
in terms of rate. Okay.
Yeah. Now here's the part where hard money is a little bit more expensive, and it's the points and the fees associated to doing the deal. So, you know, these hard money loans are very short term. They're typically 1 year. Sometimes they can go up to 5 years. But most people, most lenders, they want their money back in a year, right?
Right.
So they're going to tell you, hey, you know, your payments are going to be interest only, or in some cases, fully amortized for 30 years. but balloons at the end of a year, right? So they'll hit you with like a 12% rate, but the chances of you actually keeping this loan for a whole year is not very likely because it's basically a bridge loan. You're going to build something and it shouldn't take a year to build it.
Right.
So maybe it takes you 3 months, maybe it takes you 6 months, and then at that point you sell it. You sell it within 7-8 months, worst case scenario, and you've paid it back, right? Apart from that, there's also points that they charge up front. They can charge, and a point, by the way, is described as 1% of whatever they're borrowing.
So 1 point is 1%, 2 points is 2%.
Of whatever they're borrowing, not of the value of the home, right?
The borrowing.
So if, the home's worth $400K and they need $100,000 to fix it, the hard money lender could charge anywhere between 2 points all the way up to 5 points.
2 to 5 points.
I mean, I've seen, there's no rule, but the most I've seen is like 5, right?
See. And this is the cost up front.
Just completely upfront, right? So that means, if they charge you 5 points, you're paying 5% of the, $5K out of your 100.
Got it.
Just in fees. Plus, however long you hold that loan, you're accruing interest over time.
And so you're paying that loan off monthly.
Well, typically you have like interest only, so you're just basically holding it just to get the house to a point to flip it, right?
Yeah.
Because once that house sells, the flipper will realize his profit and the lender will get paid back, right? So they're just supposed to be bridge loans, to just get some, project done and either flip it or, if in some cases some builders have multiple projects that can pay it back from another deal or whatever, right?
Do you ever have any borrowers who are considering either doing like cash out refinance or home equity line, but they also want to know like what the difference between that and like private money? And you have to kind of consult them. Like, what would be in the case? What would be the reason why someone should do one over the other?
So I mean, the best way I can describe that or kind of answer that question would be, you want to do a cash out or a home equity when it's like your homestead because those only let you pull cash out when you're living in the house. Think about it. Like if I'm going to let you pull all the money out of a property, up to 80% where hard money does not go that high. I want to make sure that, this matters a lot to you. Like your kids live there, like you live there, because you're not going to let that, default.
Right.
However, if you have multiple properties, and you want to pull money out of something that you're not living in, the chances of you going, if you do run out of money for whatever reason, you're probably going to let your investment property go before you let
your homestead go.
Correct. Because your family lives there.
Yeah.
Right. So, if you're trying to pull money out of a house that you live in, you definitely want to go the banking route, HELOC, cash out, that route. But if you're more of an investor, just trying to make money off of real estate, and you already have more than one property, then, you probably would want to go with the hard money because it's more efficient. We can lend to you in a week. A regular loan takes like 30 days, could take 40 if it's, complicated.
Yeah.
So I think as an investor, time kills deals.
Yeah.
And so if you have a situation where you're going to buy something and the seller's excited and you got the deal on the line, you don't want them to rethink that.
Yeah.
You want to close on that, right? Because typically you're getting it for a good deal when you're investing.
Right.
So hard money's aware of that, and so they just move a lot faster. There's less red tape.
Right.
But it's a little more costly. Yeah. And not only that, but these people that are flipping, they're making a lot of money, and so they don't really care to pay.
They can afford to pay
the $10,000 it's going to cost to get this loan when they're making $100,000.
Right.
They're not going to care.
Yeah. Nice.
So
as a loan officer, what part of the industry do you like? Is it more exhilarating the investment side or the residential primary home buying side?
I mean, so it hasn't been until recently that I've been dabbling in hard money and commercial, and it's been primarily because the market's been very slow for buyers right now.
Yeah.
Compared to like the year or the year before that, right?
Yeah.
And I would say that a lot of people who are buying, to live in the house, their decisions are very emotional, for the most part. People pick houses based on where they want to live, based on what school district it is, based on how new or nice the home is.
Yeah.
A lot of people don't look at homes and say, I want this one because I'm going to make $100,000 buying it.
Right.
They look at it and they're like, oh, I could see my children growing up here.
Right.
I could see,
it's very emotional based.
I love this place, right? So when people are making decisions based on emotion, you have to realize that people's emotions change all the time. I get into a fight with my spouse. Now I don't know if I like this area.
Yeah.
He said something about the garage. He doesn't like the color of the bedroom.
Yeah.
I don't know. I've had buyers come through so ready to buy a house, and then like a parent comes by and says, "Oh, I don't like the driveway," and the daughter's like, "No, you know what? I'm not going to buy this one." And then the cousin comes through, "Ah, I don't like this neighborhood."
Yeah.
And like it's just, I feel like, you know, because it's emotional, you never really know what to expect.
Right.
You know,
Yeah.
and it is a lot of, you know, being a therapist to your clients, you know, being there emotionally for them. It's the biggest decision of their life, and typically they never go through this multiple times in their life, right? Investing, it's all about the bottom line.
Mm-hmm.
If it makes sense, there's no emotion. I'm going for it, right?
It makes sense, yeah.
So I love helping people,
Yeah.
and I love, you know, changing their lives in a positive way. And it's way more rewarding to help someone out who couldn't purchase a home get a home than it is to give a guy who already has a successful business, you know, somebody who's just like, "Oh, thanks, you know, high five, whatever."
Yeah.
But the person who, you know, didn't know that they could own a home, or maybe doesn't make very much money, and I help them get the money from the government, and we fix their situation, those people are like eternally grateful.
Right.
And it's just so rewarding to help someone like that because it feels like you're doing good, you know, on earth, right?
Yeah. Right.
You're making a difference.
In your experience, like what should a home buyer, let's say if someone wants to buy the house for the first time, or maybe hasn't bought a house in like more than 10 years, and they come to you like, "Hey, Christian, I want to buy a house. Like, what do I need to do?" What kind of outline would you say? You need to have this in order. You need to have this in order. You need to have this in order. Like, what would you say?
So typically, I first always try to get them to do the application with this question. This question is like the most asked question, right? And typically people want an answer without filling out the application because the application requires them to sit there, answer all these questions. Some people don't want their credit pulled.
Provide documents.
They're just like, "Hey, I just want to know."
Yeah.
And I say, "Well, have you ever gone to the doctor and said like, 'Hey, my back hurts, but I don't want you to draw my blood. I don't want you to take an x-ray. I don't have time to go into your office. You can't look at my back, but I can tell you what I feel, and I want you to prescribe me a medication and give me advice to fix it.'"
Yeah.
And obviously no doctor would ever do that, right?
Right.
But in our case, like it's very difficult without getting an application, because when I pull your application, I can see your credit. You know, I can see, like, for example, some people come to me, you know, and they say, "Hey, I make this much money." And I'm like, "Okay, well, let me see your paperwork."
Yeah.
You know, and then, you know, they're self-employed, their tax preparer, unbeknownst to them, wrote off a lot of things.
Yeah.
You know, and I'm like, "Well, sir, it says, you know, you
only profited $400.
You made, you know, a 10 grand this year."
Yeah.
And he's like, "That's wild. I make that in a month." And I'm like, "Well, you know, I'm regulated by Uncle Sam."
Yeah.
And Uncle Sam says, if this is what you reported to the government and this is what you paid taxes on, then this is all that I can use. Now, I'm assuming that this is a way for the government to get their cut, right?
Yeah.
They obligate us to follow these rules.
Yeah.
So, but people don't know this. There's ways of doing your taxes where you don't pay taxes and you still qualify to purchase a home. And it took me a very long time to learn this, because CPAs know how to deduct things and avoid paying taxes, but they don't know the job of a lender.
Right.
So they'll deduct things blindly, achieving the goal of not paying taxes.
What are some of the tax tips that you would say?
So I'll give you an example. I got a guy came through. He said, "Christian," he was a builder. He does construction. And he says, "I only want to pay $20K in taxes, but, you know, gross, I made over $500,000. So I said, "Okay, let's look at him." So he gives them to me. The guy owns 4 properties. All 4 properties don't have any rental income reported on the tax return. And
how is he reporting that income?
the CPA didn't want to report it because the guy had told him, "I don't want to pay taxes." And the CPA knows that as you report more taxes, you know, more income, you pay more taxes, right?
Yeah.
So he didn't report any of the rental income for any of the properties.
Yeah.
And this wasn't filed yet, by the way. I was looking at it like in a pre-filing state.
Yeah.
And, you know, he just wrote off a lot of stuff. And I said, I mean, based on this, you know, it looks like you have 4 properties that are hemorrhaging money. You know, I said, "What's going on with these?" He's like, "Well, I'm actually renting them and they're actually all making me money."
Yeah.
And I said, "Well, let's do this instead. Let's report the income on them and let's depreciate the homes, because depreciation is a phantom expense, right? It's you didn't really lose money."
Right.
You know, so when that comes to a bank, we're by regulation told that if someone has depreciation, we can add that back as income.
Yeah.
So we reported the rental income. Now we have more income, and now these properties are profitable on paper. And then we depreciated the properties. And then in addition, you know, I found out that he had like 4 company vehicles that were on his credit report. And I said, "Hey, you know, who pays for this?"
Yeah.
And he's like, "Well, they're for the business. There's no way I can drive 4 trucks at once."
Right.
So I said, "Well, let's put this as the business is paying for it. And he's like, well, it actually is. And I said, okay, well then, if the business is paying for it, then I can remove this on your debt to income ratio on your loan application, because if I hit you for this debt on the loan application and the business is paying for it and your net's already your net, then that would be double hitting you for the same
your
thing.
Your business debt, not your personal debt.
Correct. So then now I can remove that from his debt to income ratio. So these are all hacks where he ended up paying I think it was $13K at the end. And he bought $500,000 home using this type of advice, right? So those are things where
you can look out for some stuff that the CPA doesn't really have the angle to.
Which is because they don't know what we're looking for.
Yeah.
You know what I mean?
Right. So would you say, and we can kind of start wrapping up here, would you recommend for a potential borrower to, before, between January and March, right, of every year, before they want to buy a house, talk to their accountant, before they file their taxes, talk to a lender, someone like yourself, and kind of brainstorm about what you should do, because it seems like there's maybe different options people can have.
No, yeah, absolutely. Especially if you're self-employed, that's such the way that you do your taxes really dictates everything, and I think that it is really important to get with somebody who really knows what they're doing, because that can literally dictate your future and your fate on whether you're successful with this or not. So without a doubt, I think that it'd be very wise. Now, if you're W-2'd or something like that, you're not self-employed, it matters a whole lot less. W-2 people don't need to show their tax returns on a loan.
They don't.
Right.
Yeah. Because they have income statements?
Well, because they can't take deductions. You can only take a deduction if you own a business, right?
Yeah,
if I work for someone, my check is my check.
Right.
If I do have any expenses, I usually get per diem or some kind of compensation, right?
Nice.
Yeah.
Nice. Last final question. In the state of the market that we're in, we just kind of came out of the COVID bubble, right? Buyers are kind of intimidated. They're kind of scared about the interest rates kind of going up, because they're used to 2-3 years ago, 3%, 2%. Sure. So what's some advice you would say to some potential buyers who may want to buy a house in the next 3 to 9 months or maybe a year, but, they hear scary things about going on? What kind of state are we in? What would you recommend?
So, I mean, I would, I practice what I preach, and I definitely recommend buying a house right now during the recession. And the reason for that is because house prices have come down nationally, right? And in San Antonio as well. Right now, the market is very slow. With the interest rates having gone up so high and with the house value surging so high, the average buyer has been completely put out of the market, right? People who make $60K a year right now are going to struggle to acquire what they actually need to, house their family. Because, with the 7% interest rate and the same house that we're looking at, let's say a year ago, those at $200K, now being at $250 or maybe $260.
Yeah.
They're completely priced out of the market right now. Now, I tend to tell people that right now there's a surplus of homes in the market, but there's actually a scarcity of homes overall.
Yeah.
And the reason for that is because there is more demand for homes than there are supply for homes, right? Simple supply and demand. The only reason we don't see it right now is because all of this massive demand is dormant until the rates come down, right? So when the rates come down, you're going to have a massive flood of people who want to buy a house, who need to buy a house, who have just been simply waiting to be able to buy a house. So if you can afford to buy a house right now, this will be the cheapest that houses will be probably in our lifetimes. And you can get a house on discount, and you can get the seller to pay for all the closing costs. You
can have more negotiation power.
Absolutely. Yeah. I purchased the house in April. I got it with, it was $350. I negotiated all the way down to $310.
Nice.
The seller paid for all the closing costs. It appraised with over $20,000 of equity.
Nice.
And I know that if I just sit here and live in it for the next year, that I'm probably going to be sitting on $50,000 worth of equity when the rates come down.
Yeah.
And then I got to really think, am I going to sell this?
Yeah.
Or do I just try to get another one and build some kind of real estate empire? But I'm working on that right now.
Nice.
And one last thing I do want to mention for the podcast, I am working on building a subdivision. So anybody wants to get involved in that, that will be in Eagle Pass, Texas. And so if someone wanted to get more information, what's the best way to reach out to you? Oh, yeah. So my phone number is 210-275-4372. My email is c.ruiz@goalfinancial.com. You can always call, text me, DM me. Nice. Send me a pigeon. Whatever. Yeah. Anyway. Well, it's been a pleasure, Chris. I wish we had more time.
because I had so many questions, but your time is valuable, so I appreciate you being here. So with that, we're done.
Alrighty, I
Cheers.
appreciate you.
Sheesh.